Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. It's been an interesting week.
Central banks, both in Canada and the U.S., cut their so-called leading interest rate by 0.5%. That wasn't expected. Is that going to correct any economic crisis caused by the coronavirus?
No, it won't. It's a form of institutional madness where the tout has been that the central bank sets interest rate patterns or policy. And here the U.S. economy is strong, and they cut the interest rate. So it's the same as last summer where the short rates declined. The U.S. Treasury bill rate, that's a market rate of interest that trades all the time. The Fed funds, or whatever they call it, is an administered rate. And if you look at history like I've done, you'll see that interesting times like the end of great bull markets, that the Fed follows market rates of interest by about 5 or 6 months. And the key here was that last summer when the T-bill rate started down. Now, in the last 3 or 4 months, because the markets were positive and the economy was positive, the T-bill rate went up to 1.59%. That's the 3-month. And then a few weeks ago it turned down, mainly because the safe money around the world will go to the most liquid items, which is gold, and it's also the U.S. money market, like Treasury bills shorter than 1 year. So the scared money went to T-bills and the U.S. dollar, which drove the Treasury bill rate down very fast. It was down about 50 basis points in a couple of weeks' time. So this then is where the irony comes in, is that the Fed then is lowering interest rates in a strong economy. And the only reason why they're lowering interest rates is that they want to look like they're in charge of setting interest rate policy, when actually they're just following along. So in 1929, the 3-month Treasury bill rate increased until that May and June, and then tipped over and went down. And that was the leading indicator on the contraction that started in that September. And the Fed didn't lower its rate until October in the crash. So I've got all the data, and it shows that at interesting times, such as recently, the Federal Reserve or the Bank of Canada will follow market forces. And the reason why the bill rate is coming down is because there's less demand for short-term money to speculate in. Then also the careful money is buying the Treasury bills. So obvious why it came down. And just as obvious that the Fed followed the rate, and on a dummy idea that it was trying to look as if it's in charge of things. It's disgusting. But we have a question, I think.
Yes, we have a question from Henry Solomon. He asks, does the U.S. have a zombie or communist president? And he's talking about the record low rates for 10-year Treasury bills. Well, is there a zombie or commie in charge?
Yeah, well, I think it's wondering about what happens on the election and whether Saunders, the communist, wins the Democrat ticket and then wins the election. And then, of course, on Monday, the Democrats panicked and the word went through that Saunders has got to be cut off at the pass. And then the ticket will probably end up with Joe Biden as the candidate. And he appears to be suffering dementia. So, but it's highly unlikely that the Democrats can win the presidential election because the left is dividing. It's serious, and the division is between, shutting out Saunders, which is going to really annoy a lot of people, and then running Biden as a presentable candidate. And it's, it looks like neither a communist or a zombie will be the next president of the United States. It'll be quite likely Trump, who has been elected as by the popular uprising that wants to reform and make government smaller. So Trump's the executive of the popular uprising, and the popular uprising is the main move. So it looks positive going into November the 3rd.
We'll have the answer to another question for Bob when we return.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Bob Hoye. Bob, Cecil sent us an email and his question for you. With a further decline in the major markets, are you predicting a similar decline in the gold mining stocks despite the price of gold? I see the GDX dropped sharply with the markets and then bounced back with the S&P. Will that be the signs that an actual sustained bull market in the mining stocks has begun that will not just follow the major markets?
Yeah, good question, Cecil. The gold stocks will trade up and down with the big New York market. It's just the way it works. And the gold has had a terrific rally, as mentioned earlier, in a storm or potential storm. The careful money goes to the most liquid item, and that includes gold. So, but the other thing is that gold's real price, as deflated by the CPI or even by the old commodity index, the CRB, it has really been outperforming commodities. And also you can take the price of gold and deflate it by the price of crude oil. And because crude oil is a proxy for costs, energy costs. So when gold is outperforming other items, it's outperforming its costs, and it makes the industry, the gold mining industry, much more profitable. So, but the irony is that in order to get the deflation really going, it takes a bear market in lower grade bonds and commodities, as well as the stock market. So at times, if the stock market gets hit hard, as recently, it pulled back the gold stocks. But this is where our research comes in, and we've been pretty good at calling the buying points in the gold stocks over the last many number of years. And the next buying opportunity, I'm sure we'll be able to get. But the main thing is our longer-term work suggests that gold, in real terms, is already in a cyclical bull market, and this is setting up a cyclical bull market for gold stocks. And this would cover from the seniors right down to the juniors. For example, you got a junior with looks like a pretty good property, and as the real price of gold goes up, it also enhances the valuation of such a property. So first of all, it helps the gold miners in their profitability. Then it helps the valuation of geological prospects. So this would be the full bull market with the seniors going and the juniors flying. It can become very speculative, and I'm looking forward to it.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, Chinese developers are shutting down their major projects across the U.S. Can you tell us about that?
Yeah, I saw that headline. It was updated recently, and there's some major property developer has got huge towers being built in Los Angeles, San Francisco, and New York City. And the guys ran out of money and has absolutely stopped building on these things. So they're going to become sort of empty shell monuments to folly. But it reminds of in 1928 and 29 when, as part of the bull market, they planned to build the Empire State Building as then the tallest and most magnificent office tower. But they had their funding all lined up and had it completely funded so that then, despite the crash, the Empire State Building was built on schedule. And then, mind you, the investors would suffer for a decade because rents, vacancies were horrible and rents were low, and it was a very tough time. So property returns did not really improve until the 1950s. So, and this was an investment made in 29. So this thing with major office structures stopped is astonishing, and it's going to be interesting to see how it all works out.
Chinese car sales have plunged 80%. What's going on there?
Well, I guess this then relates to the virus panic, where the communist governments, who always push themselves off as being omniscient and omnipotent, and they are always striving in their mind for some kind of perfection. So they saw the threat, the disease as a threat, and they literally shut down a city. Then, of course, that then gets people panicked and traveling less, and even people in North America now are canceling travel plans. So it's made a bad situation worse, mainly because the Chinese government has panicked in their drive to always have perfection. So, and it's made the hit in the stock markets worse than it would have been otherwise. But actually, that's worth reviewing, Jim, because with our work in early October, we were looking for a good rally right out to into January, the turn of the year effect. And we also noted that some previous outstanding bull markets had completed in the January window, and that would be gold, the mania for gold and silver in 1980, and then there was the Tokyo, the Nikkei stock bubble that completed on the last trading day of 1989, and then there was a very important stock bull market that completed, I think it was January the 11th of 1973, and all of these had good dynamics into the conclusion in January, and then followed by lengthy bear market. So this is what we were working on, is that if the market was strong into January, it could complete a top such as those I've listed. And then we did have our technicals on it, and the S&P, we had upside exhaustions, which is a momentum-based model that we have. And then we also use another model that gives sequential cells, it's called. And that's based upon pattern. Well, we were getting that in stock, senior stock indexes, as well as in some of the key commodities, such as crude oil, which had a good rally. And the base metals were pretty firm, too. So one would expect into the first quarter that these things would go down. But also, I think it was the middle of January when I made the checklist, and it was one question is the market up when it should be? Yes. Then the next part of that question is, are there signs of speculation? And yeah, there were. So then it was a natural that the market would come down in the first quarter, and it was hit exceptionally hard by this panicked communist government about this virus, possible pandemic. So it's not been pretty. As a matter of fact, I did see a table that showed that for the S&P, it was the fastest 10% drop on a chart history back to, I think, 1946. But actually, there was no usual transitory stuff. You had the yield curve, which had inverted in the summer. And as we were talking then, Jim, I said that we've got the yield curve in the U.S. chart back to 1857, and there's one standout conclusion, and that is if the curve inverts, it will be followed by a recession. And the curve inverted last summer, and then it inverted more recently. So then we look back, and yeah, in 2007, the yield curve inverted twice on that transition to a bear market. And then in 1929, the curve had two inversions. And in the previous bubble, 1873, same thing, two inversions. So there is a very strong argument that this has been a cyclical peak and will be followed by a cyclical bear market. That's the way we're looking at it here now. But like any other thing, and this has been pretty sharp panic, and there are certain levels where you can find probable levels whereby you can get some bounces. But that's trading for super guys on the trading desk. But we'll just take it as the market is telling us. Oh, the other one, beyond the yield curve, of course, in the credit markets you have credit spreads, which is the difference between high-grade and low-grade bonds. And it, in the last month, has gone from two breakouts to widening, and that's serious. So we're having a typical first break that may be concluding a bear market or concluding a bull market and setting up the bear market, but it's been made very dramatic by the communists in China panicking, and then, of course, other governments, depending on their nature, if they see an excuse to get in and run things, they'll use it. So it's a delicate balance in here. But and also, as this panic ends, it reminds of one of the wisest things I read in The Economist and it was during the 1873 panic, and it was just an essay piece in The Economist with the writer wasn't identified, but it was very wise, and he said that while the panic may be over, the results of the panic are not. And that was appropriate because you went into a 5-year bear market following that one and a long post-bubble contraction. As a matter of fact, in England, which was the senior economy, in 1884, they began calling the contraction the Great Depression. And it ended in 1895. So we're talking about very serious events here, and it's always fascinating to watch and see how things match up.
Berkshire Hathaway, which is Warren Buffett's big mega investment company, has withdrawn its $4 billion of funding from the $9 billion Saguenay LNG project in northern Quebec. He's citing unstable political situations in Canada. In other words, all these rail blockades and protests that clog the streets of Vancouver every day. Is this because our government's lost control of the situation? Oh, yeah. But, Jim, has the federal government under Trudeau really lost control? They hate resource development. They hate hydrocarbons. They hate CO2. And while the one pipeline that has all of the approvals, the natural gas pipeline in the north here in BC and Alberta, it stalled out because of various localized protesters. But it would not have happened if at least 25% of the media in this country was critical of what governments do instead of being cheerleaders. But ironically, Jim, I would say the Trudeau government is very pleased that these projects are being shut down because to them, CO2 is more important than Canadian jobs. And even a year ago, I figured that with ultimately weaker energy prices and constraints on expanding production, that the drop in revenues to the federal government and also other levels of government would be such that Ottawa would become practical. Nope. If Ottawa really wanted the Western Pipeline to go through, and of course this liquid natural gas project required an extension of a gas pipeline through Ontario and Quebec, and to get that done would be hopeless. So Buffett is wise to get out, but I hate to say it, but I'm convinced that the Trudeau government internally would be very pleased to see these projects come down because, as I've said, to them, the superstitions about carbon dioxide are more important than the well-being of the economy and people in Canada. It's very pathetic to watch. Bob, thank you so much for being on the show. Yeah, we got another one done, and we had some interesting questions, and there's also some fascinating market events out there. And I look forward to meeting with you next week. My guest has been market historian Bob Hoye, the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening. Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time.
Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.